Well, hello, and thank you for joining today. My name is Vanessa McElrath. I'm a wealth management partner and an investment advisor with ML&R Wealth Management. And today, our focus will be on navigating the turbulent markets that we have certainly encountered in 2022 thus far. It seems to be that we're in this perfect storm, a confluence of multiple factors that are impacting market. And I know there's lots of concerns, I'm sure, that are on your mind, and kind of a lot of the same topics tend to pop up when I'm talking with participants in plans, and just having discussions with colleagues and friends and clients. I think people are ultimately very concerned about the market volatility. They're concerned about inflation. Of course, there's the geopolitical events, the Russia-Ukraine crisis that's impacting markets. We know that the Fed is, raising interest rates. We're hearing about other types of investments that may be tempting us, like cryptocurrency. So these are all things that we're hearing about. We're hearing about these various different topics in the news. We're seeing them in the paper. We're seeing them on social media. We're hearing about it at work with our friends and colleagues. So before we try to determine what should we be doing, what I first want to do is just take a step back. Let's look at the facts and the data. And let's not let fear-mongering lead us astray from our long-term investing and financial goals. So first, let's really focus on that topic of market volatility. So this is somewhat of a cheeky aside, but I pulled the Economist magazine. I pulled a front page of their annual World Ahead issue, in which they highlight what they think are going to be the biggest issues impacting any given year. And so here we can see the headlines and the front page for their issue for 2022, and we can see that there's lots to chew on going into 2022. But we look at these events that they've highlighted, and where were the reports on Russia and Ukraine at the time? And really, for me, I think the bottom line to remember here is that market forecasting, a colleague used to say, it makes astrology look respectable. No one has a crystal ball. No one knows what's going to happen in advance. So remember that when you're looking at newspapers or magazines or articles online, what those publications are doing is they're seeking eyeballs and clicks. So they're trying to create something that's going to really entice you to read or open up those articles. And what it's also important to remember is that there are so many thousands, if not millions, of different factors that are simultaneously impacting stock market prices. That's really the beauty of the collective market. But we don't have to be able to predict markets or get ahead of market downturns to have a positive investment experience over the long term. In fact, we should expect to encounter both good and bad or volatile markets. That's why we get compensated by stocks with their long-term rates of return. So here in this chart, I call this my bear market chart. And why I think it's handy is that it illuminates just how ordinary and temporary bear markets have been, and really how spectacularly well equities or stocks have performed in spite of them. So what we look at here is the historical performance of the S&P 500 index, which is basically just an index of the largest 500 companies in the US. And what we have done is highlight periods when the market was rising and when it was falling. And so you can see here that bear markets are defined as peak to trough downturns of 20% or greater from the highs, while the bull markets in blue are rises from the trough through the next index high. Okay, so what does this data tell us? Well, first, we can see that the total number of bear markets that we've encountered is about 16 since the beginning of tracking this. And the average decline has been just about 30%. So we can infer and see from the chart that the good times for the market have been disproportionately longer than the bad times. So we expect positive returns every day. And while there's no consistent way to predict when realized performance will be positive or negative, investors who stay the course have been rewarded over the long term. And if we look at the return over the long term, the S&P has delivered about a 10.5% annualized rate of return. I know I'd be pretty happy with a 10.5% annualized rate of return, and I think most folks would. The key is you have to stay invested in both good and bad times. And really, that's it. It's easy and simple, but we have to prepare and train our brain a bit and be a bit stoic at times. Because really, in hindsight, we're not hardwired to be good investors. We let our emotions come into play. And so, on average, if we look at the amount of downturns, it's about 1 out of every 5 years. So sometimes we have more in a shorter period of time, and sometimes we have longer stretches. But on average, it's about one drawdown of about 30% in 1 out of every 5 years. So if you can't stay invested through those times, then it's probably likely you don't or should be an equity investor. But what I often hear people say is, well, instead of writing it out, why don't I just be more strategic, more tactical? So when markets are going down, I'm just going to get out, move to cash, moving to something safer. And then once the market starts to go back up, I'll get back in. And really, I caution, because that is what I often refer to as kind of a fool's errand. Once you start timing the market, it's not just about being right once. You have to be right twice. You have to market time and be correct twice, when to get out and when to get back in. So just as an example, I caution you to avoid what I call the fool's errand. So if we go back, if you can think back to 2008, 2009, when we were experienced the worst financial crisis and downturn since the Great Depression, we hit the bottom of the market, its lowest point, in March of 2009. And during this great panic, we had seen the deepest and most savage equity market decline since, again, the Great Depression. And at that time, the market hit its low, and the S&P 500 was priced at 677. Now, fast forward a few months to June 2009. That was the time when the National Bureau of Economic Research, the NBER, they're this organization that's the official arbiter of recessions. They declare when they start and when they end, based on a variety of different factor and criteria. And they determined that the Great Recession ended in June 2009. So even though the market bottomed out in March of 2009, the recession officially didn't end until June. Well, at that time, if you were waiting until the recession officially ended to get back into the market, well, the S&P 500 had already gone up to 919 from 677. So the market had already anticipated the fact by 36% at that point. But wait, it actually gets worse, because the NBER didn't actually publicly announce the end of the recession until September 21st, 2009. So again, if you were waiting for some sort of signal or indication that the worst of it was over, again, it would have already been too late. The S&P 500 would have been priced at 1,065, or 57% higher than it was at the market low. So again, it's a very difficult proposition to try to guess, to crack the code of when to time the markets. And what can be actually pretty detrimental is just even missing a few days of really strong market rebounds in the market. So what we see here is this chart illustrates the importance of staying invested in order to capture the market premiums or returns. And missing out even on just the best week in the market or the best month in the market or the best quarter or even the best 6 months or best year can significantly reduce your overall return or experience, as opposed to just staying invested in both the good and bad times. So what I always like to say, it's not about timing the market, it's time in the market that really matters. So another way to look at it is, can you ride out the storms? Can you ride out the crisis? And we know that there's going to be a variety of different crises that we encounter, and each event is going to be significantly different than previous events. So, for example, just like COVID was significantly different than the 2008, 2009 financial crisis, just like that was very different from the 9/11 attacks, just like that was very different from the dot-com crash, and that event was very different from the US savings and loan crisis in the late 80s. So each situation is going to be very different. But we can look, how has the market responded after these major market downturns? So here we look at the performance of a balanced strategy. So just a balanced index strategy that's 60% allocated to stocks across the globe and 40% allocated to bonds or fixed income. And this is a typical allocation that you'll see for a retiree, someone in retirement or headed into retirement. So if we look at the performance of a balanced 60-40 index strategy, we can see how did that strategy perform 1 year after that major market event, 3 years, and 5 years after that initial onset. And you can see that in each of these instances, a balanced 60-40 portfolio was in positive, had positive rates of return most of the time 1 year after the event, every single instance 3 years, and every single instance in 5 years after the event. So here's another way to think about it. We can look at how many years are you in the red after major market downturns. And again, looking at that balanced global 60-40 strategy, typically, if we look at the oil crisis of 1973, you were in the red for about 2 years before you got back into positive territory. Or if you look at the dot-com crash of 2000, you were in the red for about 1 year before getting back into positive territory. Financial crisis, about 2 years. So the key is, can you be patient enough between 1 and 2 years to ride out the storms before you get back into positive territory? Most folks are able to do that. So again, that's why it makes it so important to have that long-term focus and recognize that you're not investing your retirement savings, you're not investing your nest egg for the next 6 months or the next year or the next 3 years likely. You're likely investing for the next several decades. And even someone in retirement has to continue investing to grow their assets as they continue to age. And that's what I always caution folks, even if you're in retirement or about to head into retirement, that's the importance of what I call your sidecar emergency reserves. So just a general rule of thumb is having somewhere between 1 to 2 years worth of your annual living needs saved or earmarked in something very conservative, like a cash, like a money market or CDs, so that you can access those funds and use that to fund your living needs. If for some reason you're headed into retirement during a period where the market is in a down cycle, that gives you a little bit of additional cushion, so you can use that cash to fund living needs, as opposed to having to liquidate assets that may be at a temporary loss. So it just provides you a little bit of extra dry powder. Now, another question I always also get is, well, you know, the market's at a, markets are very volatile. Maybe I'm just going to sit it out, wait it out on the sidelines, maybe not invest my recurring 401k contributions, or just kind of wait to see what's going on. And really, if we take a step back and if we look at the data, what we see is that regardless if we're at a period where the market is at an all-time high or the market's down 30%, if we look at the average subsequent one-year return after one of those highs or lows, or the average subsequent 3 or 5 year return, what we can see is in both instances, the average is a positive subsequent return for the next 1 year, 3 year, 5 year, whether you're investing at an all-time high or at a point where the market's down 30%. So again, it doesn't really matter when you invest, again, if you're investing over the long term. The expected return is still going to be showing as positive or above average. Now, again, markets, there's always going to be something that's going on. And each year, and there's going to be some doomsday event that's going to make it seem like now is a horrible time to be a stock investor. But a disciplined investor is going to be able to tune out some of that noise and look beyond the concerns of today and instead be focused on that long-term growth of potential markets. So, news and financial commentary can always try to influence our view of investing, but if we have a strong investment philosophy to guide us, we can stay disciplined. And just remember that growing wealth, it has no shortcuts. Success really requires a solid investment approach, a long-term perspective, and discipline to stay the course. Okay, so we've addressed and looked at some of the data regarding market volatility in general, but let's hone in a little bit and look at in detail at inflation. Surely, even we've all seen news articles referencing the kind of worst inflation we've seen at levels we have not seen in 40 years. And it's a little over 8% year over year recently over the last month in May. And what we see is, of course, we had really low inflation during the initial outset of COVID, and then it's increased since then over the past couple of years. And that's due to a few different factors or reasons. One is we certainly have an overinflated money supply with the Fed stimulus and easy money policies that have been in place for the last couple of years. We have supply chain issues as a result of COVID outbreaks, and we also have additional supply chain issues as a result of the Russia-Ukraine war. But if we look at CPI, that's the measure of inflation, and we look under the hood, you can look at price increases over various different types of goods and services. And what we see are the biggest price increases are being driven by just a few factors. So mostly energy prices in used cars are kind of the biggest outliers there. Now, if we look historically, over the long term, the median rate of inflation has been 2.68%. And if we look over the last 10 or 12 years or so, we've had incredibly low inflation, and it's actually been even below average. And now, obviously, we're seeing a little bit of a spike that will probably get us a little bit closer to that long-term median range. What we don't know, however, is how high will it go and how long will we have above average inflation. But we have different ways that we can cope with inflation or mitigate inflation. And that's mitigating the impact of inflation on the purchasing power of our wealth. And it's not going to be by mitigating inflation by using exotic investments like gold or cryptocurrencies. When we look at the data, we see that high real return assets and inflation hedging assets are what help mitigate inflation. And high real return assets, those are just assets whose expected returns are high enough to outpace inflation. So something that's going to grow at a faster rate than inflation and grow the real value of your wealth. And that basically is just a diversified basket of stocks. So here, if we can look at different types of assets, and we can see that just the broad-based equity market, a broad-based basket of stocks, has produced rates of return to outpace inflation, even in just years where we have above average inflation. So that provides some degree of solace. If you are a stock, if you're an owner of stocks or equities, you have some investments that are going to help mitigate the impact of inflation over the long term. And if you have exposure to small cap stocks in particular, that also is going to provide a higher rate of return to outpace inflation. Now, again, as I mentioned, we're at this period where inflation is reaching really high levels. But what we've seen is the Federal Reserve, they are acknowledging that it understands it has to take action to tame the overinflated money supply. And they're going to do so by raising rates. And they've already started that. But sure, as a result, by raising rates, there may be some short to intermediate term pain to be endured here. And then again, there may not be, it may be short-lived. But if there is, I would caution, let's try to experience it as a kind of financial chemotherapy. Okay, basically, let's do whatever it takes to destroy the cancer of inflation, because runaway inflation is truly the biggest risk to any retiree or investor for retirement. So we know that the Fed is doing this, that there may be some short-term pain. But do we know, what does the data tell us about the future for stocks and bonds if we're going to be in a rising interest rate environment? So again, when we look at the data, we can see that there's not much actually of a correlation. So this was a study that looked at stock prices and the correlation between stock prices and interest rates. And what you can see is it's largely random, it's unpredictable, so no direct correlation. We've seen stock returns be positive and negative in both in rising rate environments. We can also hone in on bonds. Well, how have bonds performed in various periods during rising rates? So we had a period of rising rates between 94 and 95, from 99 to 2000, 2004 to 2007, and then 2015 to 2019. And in each of those periods, we look at a variety of different bond indices, segments of bonds, and they all posted positive rates of returns during those rising rate periods. So again, it doesn't mean that necessarily we're about to head into a period where we're going to experience negative bond or equity returns. But we can see, if you looked at the market, you may have seen some articles referencing that the first quarter of 2022, it was one of the worst quarter for bonds since 1980. And bonds in aggregate posted a return of about negative 5.93%. And technically, it was the third worst quarter on record. Certainly, this is happening for a variety of different factors. We know rising interest rates are impacting bond prices. But in the long term, that's not necessarily a bad thing. We know it's going to help get inflation under control. And then ultimately, with rising rates, yields will rise, and that's going to produce more income from bonds that are going to get paid to those bond investors. So ultimately, it actually should yield good, positive results. However, it's also important to just keep in mind that just because we had a bad quarter, it doesn't necessarily give us any indication on what will happen in subsequent quarters or where bonds will end up this year. So as an example, we can look back to 1980. And the first quarter of 1980, it was the worst quarter for bonds on record, period. Bonds posted a negative return of 8.72% in that quarter. So if you would have gotten spooked, though, and sold out of your bonds, you would have then missed the best quarter ever on record, which was the second quarter of 1980. And bonds posted a return of 18.8% in that quarter. That's pretty dramatic. And then third quarter, second worst quarter on record. They went back down almost a little over 6.5%. So as you can see, 1980 was an extremely volatile year for bonds. But if you got panicked or spooked, you probably would have missed out, because actually the results of a volatile year, the US aggregate bond index still delivered a positive annual rate of return of 2.7% in 1980. So again, just remember, keep your eye on the prize, and remember that these little storms, this too shall pass. So over in the long term, we know interest rates will stabilize, bond prices will stabilize, inflation is going to be tamed eventually, and that's going to transition into higher yields on bonds, CDs, and savings rates. And the stock market will eventually recover. The stock market has never delivered a permanent loss to a long-term diversified investor. Now, one of the other dominant headlines, especially when there were a lot of concerns around inflation, when some of the stimulus rounds were initially going out in 2020, and many folks were starting to tout cryptocurrency as a good hedge to inflation. Well, now that we actually have inflation, we can see that it wasn't a good hedge. When stocks went down, cryptocurrency also went down, and inflation went up. So just remember, this is kind of a funny quip that I'll pull. This was from HBO's Last Week Tonight with John Oliver, and I think he put it pretty well. Cryptocurrency, he said, is basically everything you don't understand about money combined with everything you don't understand about computers. And basically there's a lot of people that are investing or purchasing and buying cryptocurrency, but they don't really understand. And when we look at it and take a step back, cryptocurrency itself, it doesn't really produce anything, and there's no intrinsic value. But a lot of people have been attracted to it just solely because of the surge in price and the returns over the last several years. But I always go back to the old adage, if it sounds too good to be true, it probably is. And there's really no get rich quick schemes when it comes to investing. So, and there's still, again, it's the Wild West. There's still really a lack of transparency, a lack of regulation, and there's still a lot of risks out there. There are several stories. Coinbase, it's a cryptocurrency wallet. They had some filings with the SEC where it really shed some light on some lacking, bankruptcy protections against folks that had accounts with Coinbase. The Terra USD, which is a stable coin, it was delisted from cryptocurrency exchanges. So again, there's still a lot to be untangled here. And the key is I think it's important, whether it's cryptocurrency or just individual stocks like meme stocks like GameStop, or people putting all of their eggs in one basket, just putting all their money in one company like a Tesla because it's done really well, is that you just have to determine and really acknowledge, are you speculating or are you investing? Because I think it's really important to know the difference. If you're speculating, you're taking undue risk. And you just have to be comfortable with the fact that if it goes to zero, it's not going to give you heartburn. So if you're going to invest in cryptocurrency, or you're going to invest in a GameStop or a Tesla, just do it with an amount of money that, again, if it goes to zero, it's not going to have a detrimental impact on your retirement, or it's not going to help make you lose sleep at night. And Warren Buffett has a good way of putting this. He said, you only find out who is swimming naked when the tide goes out. So, over the past couple of years, it seems like it's been a no-brainer to invest in cryptocurrency or investing in Tesla. But now we're going through a volatile time, and we can see that there's nothing that's completely bulletproof where you're going to get totally, you're going to make lots of money and have no risk. So really the key, if you're truly investing, is you want to have a sound and prudent approach to retirement. Again, if you want to invest in something like a cryptocurrency, again, do it with an amount of money. It's not going to give you heartburn if it goes to zero, but don't do it with your nest egg that you're relying upon for retirement. And what we've seen is that capital markets in general, just the basic stock market, has rewarded long-term investors. And we can see this documented. If you would have invested $1 in these various different segments of the market indices, it would have produced the real growth that you need to grow your wealth for retirement. Now, sure, there's little blips along the way, and you're going to encounter both good and bad markets. And there are certain things that you can do that will help you navigate those little blips. And one of those is diversification, because it's going to smooth out the bumps. And a well-diversified portfolio, it's going to provide the opportunity for a more stable outcome than investing just in a single stock or single asset class. That way, it's not all going to move in sync. So with a diversified portfolio, you're not going to own enough of any one stock to make a killing, but you're also not going to get killed by any one stock. So that's the beauty of diversification. It's going to take the guesswork out of investing, because you never know which markets will outperform from year to year. But if you hold a globally diversified portfolio, you'll be positioned to capture those returns wherever they occur. So for example, here we look at these various different asset classes. We look at the S&P 500, the Russell 2000, which is small US companies, the Dow Jones REIT index, that's real estate, international. And if we rank them, these asset classes from highest to lowest in every calendar year, you can see it's pretty random. There's really no discernible patterns. And so if you own all of these different asset classes in your portfolio, you're going to come out with a more consistent, smoother approach, kind of somewhere down the middle from year to year. It's going to minimize some of that variability. Now, one thing that I've often heard from investors and participants recently over the past couple of years is, well, why do I want to be a diversified investor? US large companies have performed particularly well over the last decade. Why should I invest in other securities or invest in international type of stocks for diversification benefits? Seems like that would have hurt me over the last 10 years. If we look at the last decade, let's say if we look at 2010 to 2019, that's certainly been the case. If we look at the US market, the annualized rate of return was about 13.6% versus international developed, that was about 5.3, and emerging markets was 3.7. So certainly foreign markets trailed the US market. But that's just one snapshot in time looking back in the rearview mirror. If we would have gone back even further to the decade before, so let's look at 2000 to 2009, if you would have just invested in the US, you would have actually you would have lost money over that decade. But if you were a diversified investor and invested in international and emerging markets as well, you would have ended up in the positive, in the red. So again, diversification, we don't have that crystal ball, but it's going to help smooth out the returns over the long term. So ultimately, investing and trying to navigate these turbulent markets, it's about, instead of being reactionary, it's focusing on what you actually can control, what's going to add value. So first, make sure you have a plan and that it fits your needs and risk tolerance. So kind of do some cursory planning about, what's that nest egg that you need for retirement. And then structure your portfolio to make sure it matches that plan and that risk tolerance. Then make sure you do it in a very diversified manner. And then focus on things like expenses, turnover, and taxes. And then probably one of the most hardest parts is just being able to stay disciplined through market dips and swings. Again, we're not hardwired to be good investors, but if we can kind of quell or silence that nervous little voice in the back of our heads and stay focused on a disciplined approach, it really will lead to better long-term results. So certainly there's going to be a lot of other things that are come up in the market, and I'm sure you still may have questions about recent market volatility. What I've done here is I've included my number, my email address, as well as our internal team here at ML&R. So feel free to reach out to either of us if you want to set up a time one-on-one to talk with any of us, or if you have any specific questions. That is what we are here for. We're here to help coach you through these turbulent markets.